My guest on episode 24 of the Sensei Kujaku show is Devina Mehra of First Global. Devina has been featured in Fortune India's 50 Most Powerful Women list and has, over 3 decades, cemented her position as one of India's preeminent investors. It was fascinating listening to Devina expound on many aspects of investing and lessons learned over a storied career. The early part of Devina's career was spent at Citibank before embarking on a journey that would make First Global one of the few Indian firms with global reach, including gaining membership of the London Stock Exchange in the late 90s. As an interesting aside, the director of IIM Ahmedabad, from where Devina received an MBA, wrote her a letter stating that she was the best student he ever had. Hi Devina, welcome to the Sensei Kujaku show. Thank you so much for coming on.
Hi, Krish. Great to be speaking with you.
So Devina, you must be feeling pretty smug right now when you look at some of the banking numbers that are rolling in over the last couple of weeks, given that you've historically and even now more recently spoken about your skepticism regarding that sector and that business. But you've spoken about this a lot, so I don't want to, have you repeat yourself unnecessarily on this topic. But there's specific aspects of the banking and lending business that I want to discuss with you. The first is the idea of scale in that business and how you think about scale. And people often, I hear people say that one side they say invest in the bigger banks because they're safer, and another school of thought is invest in the smaller banks because since they're smaller, there's sort of more headroom for growth. But how do you think about scale in that business? And what are your thoughts on size of a bank or size of a lender when evaluating that business?
See, the thing is this, of course, as I have said often enough, I'm a nervous investor in banks. And because lending is so hard to evaluate from the outside, that where are the negative surprises hiding? And in banking, overwhelmingly so, you will get negative surprises rather than positive surprises because and sitting outside, you don't know where the problems in the loan book are. And I always laugh when people say that this lender is growing faster than expected. And I say that how hard is it to, give out money? It is the recovery of the money that is the problem. So coming back to the scale question, the scale is good for technology, for bringing down your overheads, that sort of thing. It may or may not be so good on the quality of the loan book. Sometimes a very focused lender selling only to lending only to a particular type of borrower or in a particular region might really know that really well and have a very low default rate compared to somebody, especially how fast are you scaling up and are your systems able to keep up? Is your risk control just as good when you were a lot smaller? Are your credit criteria as good as when you were a lot smaller? So scaling up is risky in banking. So if you scale up too fast, you might end up with a mess. So that's the thing. So it reduces overhead, especially it can help you invest more in technology. But there is a risk associated with growing too fast, which is scaling too fast. And always having been in the market long enough, every decade, there is some form of lending that becomes fashionable. And more often than not, it ends up with a bust. And there's so many things which are just repackaged. I mean, I laugh when a BNPL, buy now, pay later scheme. I mean, it is the age-old installment buying which was popular even 100 years ago. So most innovations in banking, that's the saying goes, come down to just ways to increase leverage.
Yeah, but that the BNPL is such a fantastic example of this, of what you said, which is just the same thing repackaged in a fancier way for a new generation. But I want to talk about this study now, extrapolate this to a larger point, which is why do people fall for fads? And I use fads in an inverted comma because there's a point in that phase where people think it's not a fad, they think it's the next big thing. So I want to get your sense of how, as an investor, you differentiate between fads and what are truly once in a generation opportunities. And this is looking into the future. It's easy to say with hindsight that these things are fads versus genuine opportunities. It's like being in, in the tech sector in the, say, 60s, 70s, 80s in the US. I mean, there's a million companies that came up, but ultimately only one became Microsoft or Apple, right? So how do you, looking ahead as an investor, differentiate between the two?
The first lesson is that you can't know the multi-baggers in advance. That this is a question I get often from retail investors also, that you saw HDFC Bank in 1996, you saw Amazon in 2001. In fact, ours was the only buy on the street on Amazon in 2001, and that was a strong buy. But that anyone who tells you that they can know in advance which is going to be this multi-decade multi-bagger is simply lying, because there is no investor, no fund manager, no one in the world who has had a portfolio of only multi-baggers or even 70% multi-baggers. It doesn't exist. Not Warren Buffett, not Rakesh Jhunjhunwala. Everybody takes hundreds of bets, out of which a very small proportion account for most of the returns. Rakesh bought hundreds of stocks, but 3 or 4 is where he made his money. Same Warren Buffett says that if you in his like 60 plus years or whatever, 70 plus years of a career, said only a dozen decisions have accounted for all my returns. I mean, I wouldn't even say outperformance, because last 20 years he has not outperformed. So, so that's almost impossible to say. When at the most, when you have a very high conviction bet you are putting on, I mean, I don't like to actually use the word high conviction, but whatever, I mean, the best thing you can bet on, at the most you can say that this will double or triple. Beyond that, the visibility is not there. I mean, beyond that, I mean, Aditya Puri or Jeff Bezos did not know that this is where the stocks would go. So that is one. The other thing which I would like to say is that just because something transforms the world. I mean, right now, people are talking of, for example, green energy investing or things relating to that. So I'm saying that doesn't mean that investments in those areas are going to reap you mega returns. If you go back over a century, automobiles and aviation are two areas where the really human life transformed, but they have been a graveyard of companies. So you don't know who the eventual winner will be, even in a very promising new area. So those are the things you have to keep in mind. Don't get carried away. And in any case, in any new high risk area, that should be a very small portion of your portfolio. Don't bet the bank on that sort of thing. And as I said, nobody knows who will be the winner. I mean, mobile phones at one point, Nokia, BlackBerry, those were the things to beat. So, I mean, and now the cycles are getting shorter and shorter. If you look at the 1960s, 70s, the average company in the S&P was 60 years old. By 2015, it was down to 18 years. Now it must be even lower. So the cycles are getting shorter. People are getting competed away much faster. You don't know whether mobile phones itself might be the standard 10, 15 years ago or later, or might be some other gadget. So world is transforming before our eyes. So any new high risk area, I mean, bottom line, whether it is IPOs or whether it is this kind of thing, or if for that matter, small caps, limit your high risk exposure.
You made a really important point towards the start of your answer, which was that in investing, and I suppose life more generally, just a very tiny fraction of the decisions you make are the ones that really make a difference. And one or two right decisions can wash away a lifetime of sins, right? So you can have that one, if you have one titan, it kind of doesn't matter what the other 99 are, in a sense, right? So I want to just almost use you as my therapist for the next couple of minutes and understand from you that is it wrong? Is there something wrong with me that every time I look at a stock and I choose not to buy it for whatever reason, whatever that reason may be, and then suddenly it takes off like a rocket as soon as I say no? Is that something I should I cry myself to sleep every night, or is it just, do I just have to accept that as a fact of life as an investor?
That will happen, and I'm sure that would have happened quite often in the last year and a half when so many small caps of somewhat dubious prospects have also taken off. I mean, let alone there have been good ones also. I'm not saying all of them were bad, but I'm saying there have been all kinds. So I mean, you have to, as I said, be disciplined and have a system. So you will not get all the winners. Maybe sometime when you get out of something also, it can happen that you on a stop loss you get out and then the stock takes off. So that can happen, but this is all about averages. That on the average, does the stop loss save you loss? Does turning away a lot of high risk bets? What does it do? And many things are not cannot be foreseen. I mean, Apple for a good 20 years, not a short time, 20 years after its IPO gave no returns. So did somebody who turned it down in the IPO make a mistake? No. I mean, even after Steve Jobs, now this is something people don't know, that even after Steve Jobs came back for 7 years, not 1, 2, 3, 7 years, Apple did nothing. It was a marginal loss, marginal profit company for 7 more years. Then one product takes off and you start to look at everything through rose spectacles. So the point in investing is be systematic so that on the average you do well, because investing is a loser's game. This is your viewers can Google this. It's an old article by Charles Ellis called The Loser's Game. I mean, he's written a full book on it, but I mean, the article is good enough. So that is that everything in life is either a winner's game or a loser's game, and the same game changes characteristic. So if you look at aviation, for example, when JRD Tata and Charles Lindbergh were flying, it was a winner's game. It was an adventure sport. And that famous Karachi-London flight of JRD, at one point, the one part was not available. He had to improvise and use something else. But now there is only one way to fly the aircraft. Make no mistakes, go by the checklist. So also in investing, there was a time when nobody knew about companies. You could know something about a company, and certainly there were no spreadsheets, access to financials was not easy. So your, grandmother could have found something which nobody knew about. But if you look at investing today, first of all, data is available to everyone, including con call transcripts and everything. I mean, there was a time when if you wrote a negative report on a company, they would not call you for the next analyst meet or con call. And this I'm talking Tata companies. So now everybody has access to data, and the smartest people in the world are in the markets. So if you say that you will be this genius who will always find the one nugget which no one else has found, I mean, you are, you're delusional. I mean, I still find fund managers saying that information arbitrage is gone, but I will still outperform. Then you're saying that you're smarter than everybody else in the market. And that doesn't hold ever for any, extended period of time. So the game in markets always is that prevent the big loss. Be in the game. So it's a loser's game. So the one who doesn't lose wins. So we always say in our PMS, or for that matter, our global products or a small case, that our first objective is not to lose big money. So 60% of the fees you are paying are for risk management and 40% is for return management. Of course, since we started this month, it will be 4 years. We have been by far the best on returns, but on risk-adjusted returns, weather versus volatility or drawdowns, there's nobody even close. Nobody even close, because that we are obsessed with managing risk and managing downside and managing not high. So I mean, like in the small cap boom also, we could see the boom because we have systems which signal that, but we never go beyond. I mean, right now it'd be 15-16% stocks which are below 5,000 crore market cap. We don't look at stocks below 1,000 crore market cap. And even besides the market cap criteria, we are also very obsessed with enough liquidity that if you want to get out, you can get out. That's the other problem with small caps, that in large caps, at least stop losses work. In small caps, the stock can disappear. You can't get out on the way down.
Right.
Sometimes in these sorts of markets, especially when mid cap, small caps do well, sometimes, like you said, it's not that every company that's going up is actually a good company or deserves to go up. So I want to understand from you, when you look at companies, is it the case that every company you look at, there is a price at which you will buy it, or are there cases where you would say that, I don't care what it's selling at, I don't care how cheap it looks, I'm simply not going to enter?
Yeah, it could be the latter. And I had tweeted a while back that always remember that something that has gone down 95% can go down another 95%. I mean, the example, of course, I had given was Byju's, which went down, the valuation went down 73%, then it went down another 83%. And as of last week, from that 73, down 73%, then another 83%, now it is down another almost 98%. So that can
And
happen. So
it may still be expensive. So
that's what. So I mean, from whatever, so now it is down to 22 million. When it was, more than 1,000 times that at one stage. So, it is not that something that has fallen is necessarily a good buy. So that is not. So you always have to make that judgment. I mean, you have to look at it at current prices. Just because it has fallen doesn't mean make it a good buy. And don't forget your school arithmetic, as I say, that school arithmetic and elementary probability. So never forget that that markets are about the future, which means that they are about probability. No one has this crystal ball that they know for sure what will happen later. So which is why for 30 years I have never given at the beginning of the year or on Diwali Sensex or Nifty target. It's only last year when I read Daniel Kahneman's Noise, I got a word for it. He said that this is objective ignorance, that this is a thing not only that you don't know, but you can't know. And yet, so-called experts come and pontificate on in media with great confidence. So another, thing which people must remember, that confidence does not equal competence. So anyone who gives you an index target, ask them that last 10 years, what did they predict and what was the answer? What was the reality?
The trick is to make enough predictions that eventually something will be right and people will forget the ones that didn't work out.
Yes, that's another thing. And of course, the way the large Western investment banks in particular play it is that they have a number of strategists who are all saying contradictory things. So at least one of them will be right. So at the end, you can say that so and so was right. So,
That's a good tactic. Then come what may, no matter what, no matter how unlikely an event is, you've predicted it. So exactly. So Devina, you've spoken a lot about core sort of principles and sort of guidelines you have, and I want to talk about something in particular which you put out some time back, and I'm just going to read it out as sort of guiding principles and things that you sort of hold sacrosanct when investing. And it goes, never use a formula when you do not know its derivation. Can you explain what that means, and specific to investing, how do you apply that?
so I mean, the point here is that don't use something you don't really understand. So, for example, I mean, I had people who would use a terminal value calculation in a discounted cash flow calculation and not understand what it was actually doing. That it was summing a series with a certain growth rate discounted at a certain growth rate. So that you did not even really understand what that number was doing. Or for that matter, any model you use, you must know what the assumptions are. What are the things it is not doing? In fact, this is one thing which I was very happy with, because we just went past the 30-year mark in First Global. So we were looking at some of our old reports, and like there was a 26, 27-year-old report called What Works on Dalal Street. So we had back tested a lot of parameters to predict markets. What I was happiest about in that report was that all the constraints all the things which this was not doing. I mean, I did not have the word survivorship bias at that stage, but I have explained that this is what it suffers from, because we don't have that data. We don't have the predicted earnings, at a point in time. We only have the actual earnings and so on and so forth. So it sets out all the constraints. I can't add a constraint or the assumptions which I can't add, all the limitations in a sense of that study. So be very clear what you are doing. I mean, even without the vocabulary, I was happy that I got the limitations right. So always be clear what the assumptions are, what the limitations are. Otherwise, that जो एक headline thing that this is what it is without really understanding. So in any research report or not a research report, a research paper that you see, they will always lay out what it does and what it doesn't do. So, just looking at the headline is not good enough. And always question. Like when I started the equity research in the 90s, efficient market theory was the absolute standard being taught from University of Chicago onwards. But I said that if a stock changes prices, let's say by 50% during the course of a year, not a year, a quarter, with no fresh information, then was that price efficient or is this price efficient? What does this mean? If you are looking at beta, if you calculate the beta of a stock for different periods of time, it is almost invariably completely different. So what is the beta of this stock? You have to question. I mean, that's been the DNA of our firm and for myself also. That does it make sense to you? I mean, unless you understand it from first principles and it makes sense to you, do not use just something that someone has told you on a one-line basis that do this and this is the way to nirvana. No, I mean, as I said, that was, in fact, the tweet you are quoting. I had also said that no, don't take anything for granted. What's in textbooks, what professors tell you, what I tell you, unless you can test it and see that whether it is true or not true. Does it hold or doesn't hold? So, I mean, I am a learning junkie. So, as I say that in this business, the input and output is money, but I'm really there for the learning. Very few careers in the world where 30 years on, you can still say that every day you are learning, that you don't know it all. In fact, you can't know it all.
Right. Right. No, fantastic.
Absolutely, I can't help but agree. And Devina, you were talking about some of the earlier sort of phases of First Global. Do you remember when you officially became a full-time investor, trader, however you want to describe yourself? Do you remember the first stock you ever bought?
Actually, I mean, I became a Bombay Stock Exchange broker. So that was the beginning. So 1993 is when I resigned from Citibank. I was in Citibank before that. And of course, when you are in Citibank, there are constraints as to what you can do because, naturally, there are limitations on you might be dealing with a company, therefore you can't buy that stock. But my best investment in the beginning was actually made in Citibank, which was so Citibank was setting up this securities company where, as per the regulations, then they could not hold 100%. So part of those shares of this unlisted company, we could buy as employees. And that was later on listed as Citicorp Securities. So I think that 25,000 I put in became over 1 crore. So you can say of my initial investment, that was the best ever. That actually provided the capital to set up the
Yeah.
It's remarkable though, whenever I talk to people who've sort of succeeded in this space, and actually I think in many industries, it's so important that relatively early on they have they taste that success, right? Because often what happens is, like, if your first investment goes the other way, sometimes you think, because it's important that people often don't see themselves as the problem, right? So it's like when they lose money, the market is a gambling den, but when they make money, it's because they are brilliant, right? So having that initial success often is so important to spur you on to you fulfilling your potential.
Spoke about is classic attribution bias. So I always say that after a good phase, like people have made a lot of money in small and mid caps in the last year or so. If you ask everyone, they will tell you that how great they were at picking these stocks. So in success, the most of your you attribute to yourself. But whenever the crash comes, it will be that central bankers did something wrong. There are stock operators. This management was a thief. All those things will come up. So in the failure, risk, which is essentially luck, is blamed. In your success, only you are the mover and shaker. So whereas in both, this is also an important lesson in investing, that investing is always about skill and luck. In fact, the whole every human endeavor is about skill and luck. There's only chess is almost all skill. Every other game is a game of skill and luck. So we always were aware of it. So that is why they said that, we manage risk, because we understand there are known unknowns, there are unknown unknowns. So you cannot see the future. In fact, when people come into the markets, and I'm talking particularly because I've trained literally generations of research analysts, because I used to hire only freshers. So I get all these, letters on Teachers' Day and Guru Purnima and all that. So, but one of the key things which you have to teach right at the beginning is being comfortable with ambiguity. So, because otherwise, all through your education system, you have this thing that this is the question and this is the answer. There is only one answer. Whereas life, and particularly investing, is not like that. So, that's a difficult switch in the beginning to make, that you will always have to work with incomplete information. Because by the time you get all the information, the price move is gone. So the market is about ambiguity. And I mean, if people after living through 2020 don't know that at the beginning of the year, who would have said that airline, hotels, and so many other businesses will go to zero? And if I had told you that they will go to zero, would you have said that there will be a massive bull run? So both those legs were unpredictable. In hindsight, we all think, yes, we always knew this was going to happen. That's another bias. That in hindsight, you always make your brain is wired to make you look good. So you don't want to admit mistakes. That's why it's important to have a system. Otherwise, as a human being, you don't want to admit mistakes. You want to attribute successes to yourself. You say, but I always knew it. That whereas you might have been saying the exact opposite thing at that time. So a very interesting human.
Yeah.
So Aerial Investments, which is a large sort of fund out of the US. So I don't know if they still do it, but they used to do it. So every time they hired a new batch of associates, what they would do is they would say at the start of the year, each of them has to make what they call, I think it was called a negative list or something like that, which was basically to see which of them can lose the most money in this hypothetical portfolio. And it was, and these were all, MBAs from the best schools and all the, IQ in the world. And it was such a humbling process most of the time, because it seems so easy, right? If I say, here's $100, lose as much as you can in the market, you should be able to lose like $100, right? Because we're all so smart. And it's unbelievable how many of these people, with all the training and IQ in the world, the negative portfolio often outperformed things that they considered good investments. So things that they considered. Yeah, exactly. So and like you said, this is after selecting for quote unquote high performers. It's not like they went on the street and said, threw a rock and said, okay, what do you think is going to go up or down? So yeah, no, it's remarkable hearing about, and it's fantastic hearing about this in actual practice, right? It's one thing saying, oh, in theory, this is what happens, and when you see it live, it's actually a phenomenal sort of thing to witness. But Devina, I want to come back a little and talk about assessing an investor, or in your case a fund manager, but just basically even yourself for that matter, if you're investing yourself. So would you say that X is a better investor than Y simply because X has a higher overall return than Y? Or put more generally, is absolute performance the only metric to judge whether someone is a good investor or not?
I think one, of course, the time period you're judging is one. And also, as I said, we always look at it versus volatility. Volatility is what? Standard deviation of returns. So the Sharpe ratio kind of tries to capture it, or you can just look at returns divided by the standard deviation, which is the volatility. One other factor which you can use is gain to pain, which is returns relative to drawdowns or the losses along the way. So the way it is that of your returns are divided by there are months when the returns are negative. So absolute value of the negative returns, the sum of the negative returns. So if you're looking at 3 years, maybe 14 months were negative. So the sum of those returns divided by the actual return you made. So that shows you that how much pain did you have to endure to get to those returns. So these two, so basically versus the volatility and versus the drawdowns is the way these are two simple ways to look at it. And that's something we do focus on. As I said, that our whole thing is that manage the risk. And manage the risk means what? Like, for example, the day the Russia-Ukraine war broke out, the market fell 15%, our portfolios fell 1.6. So we've lived through a lot of these stress tests. So we know that it works. In fact, it works better than what we expected it to work even. So but we do it on a systematic basis. So there are many legs to this. So for example, if we like industrials and capital goods, we are not going to put 40% of our portfolios in that. So there is always, diversification is one of the things which we look at. We look at stop losses and the sectoral allocation itself, meaning which sector does this company fall in itself is done on a systematic basis. Like for example, Reliance, which sector is it? Is it energy? Is it telecom? Is it retail? What is it? So there are segments which move with different segments. So we do it on that basis. But I'm saying even on a relatively cruder basis, the fact is that you should not be too skewed towards a single sector, which is also, one of the, this simplistic thing which is talked about, that invest in your circle of competence. And I say that, that this is a euphemism for comfort zone. So if your fund manager is investing in her or his circle of competence, if they understand only FMCG and banks, why should you be stuck in only FMCG and banks? Because see, no theme lasts forever, whether it is asset class, whether it's geography, whether it is sectors within a country, no theme lasts forever. So if you're stuck in one theme, it will do well for a while. So for 2 years, you might even be a great performer, but then it will catch up with you. So often we get people who come to us and who will say that I put money in this mutual fund or this PMS. 2 years it did very badly. Now last 1.5 years it has done well, or vice versa. That's what will happen if you're not doing it on a systematic basis. Now, what has of course happened is, this I've seen for 30 years, that anything we talk about, at least the phrases people pick up. So we talked of asset allocation, people started talking of asset allocation. Global diversification, you think, buying a NASDAQ ETF is global diversification, because you don't really understand. We've been global for 25 years, since 1999. So we understand what we're talking about. Diversification is the latest buzzword some investors have picked up. So I was talking to this industrialist, and he tells me that, there were these people who used to come with their PMS and say the whole positive thing in PMS is buying only 12, 14 stocks, and that's what will give you the outperformance. Now they are coming back and saying, no, 40, 45 stocks is good. So what has changed in the last 2 years? And I said that the only thing which has changed is that they've seen our performance. But again, you're not going to first principle. It is not diversification that works. What diversification does essentially is, in that skill plus luck game, it reduces the impact of luck and it increases the weightage of skill. So your real results will be closer to your skill level. It is like tossing a coin. If you toss a coin 10 times, you might get 8 heads or 8 tails or 9 heads. But if you toss it 100 times, it will be closer to that 50-50. So if whatever your skill level is, the diversification gets you closer to that skill level. But if you don't have the skill, just buying higher number of stocks is not going to get you there. So you have to understand what you are doing. If you're just, it's very easy to copy the buzzwords. And I've seen it all my life. That everyone copies us, but you have to understand why.
Buzzwords. What do you, so right now everyone, for example, everyone's talking about AI. I'm talking about in investing specifically. Like, everyone loves talking about AI, and companies that have nothing to do with AI are talking about how they're using AI to make their business better and all of that. But if you look at, say, the 30 years that you've been investing, and this is again not specific to India, this is anywhere in the world, what do you think have been some of the craziest buzzwords or hot fads that you've come across? And what was your initial reaction? You spoke about BNPL, for example, earlier on. What was your reaction when you heard some of these things, and do you at times feel like, was it okay? First, you may be annoyed at how are people falling for this, but do you, maybe not explicitly, but do you internally ever think, thank God for these people, because if everyone was as smart as me, I'd never make any money in this market?
No, I have no illusions that I am smarter than the market. But some things, of course, are buzzwords. Some things are real changes. I mean, AI is a real change. We ourselves have changed our whole investing system to that. And I was, I came from the old school. In fact, I was a pioneer in the old school itself, because when I went into securities research in 1993, that profession did not exist in India. I had done my MBA from IIM Ahmedabad, but no, we didn't even have a module, let alone a full course on securities research, because that profession did not exist. And first, I tried looking at all these foreign brokers and securities houses who had been doing it for, Wall Street firms, which had been doing it for 50, 100 years. But I found their work, frankly, junk. So I said, let me go to first principles and do it. So, which is what I did. And I really enjoyed that heat and dust of research in the 90s, that in NCR you start from Greater Noida, go to meet maybe uh, some of the auto ancillaries there, Motherson Sumi or something. Then you come to Delhi and meet some companies, and then that time Gurgaon was a wilderness. So and then, you are on this empty road, and then there will be two companies on the side. There will be an auto component, there will be Carrier Aircon, then maybe you go to Hero Honda and Haruera. So, I did a lot of plant visits also in pretty remote areas, not even close to cities. So, I'm talking like the middle of nowhere in Andhra, and looking at Hindalco's plant and a lot of steel plants. So, that was fun. But over time, the game changed. This is what there was a time when there was an information arbitrage, and not just in India, but even in the US, Fidelity could sit in a room with a PNG or an IBM and get some information. Now it's been regulated away across the world that information has to be available to everyone. So, the analogy I give often is that it is like when hockey moved. Hockey was our national game. And why was it our national? It is still our national game. And why is it our national game? Because India dominated hockey from 1930s to 70s. People today will not know this, because we've been nowhere for 40, 50 years. We are only now making a comeback. And the reason why we went from top of the pops to nothing was because the playing field changed from grass to artificial grass or astroturf. And therefore, the skill set required change. So you had Major Dhyan Chand's great stick work and that kind of thing. But those were no longer the critical skills on astroturf. It was fitness, speed, etc., which Indians and Pakistanis were not as good. So that is the change. So, in investing also, that information arbitrage is gone. So now you have masses of data, which is available to everyone. So now the skill set is who's better at analyzing the data. So it's a different skill set, and that's where AI ML came in, and that's why we launched a PMS also. PMS license, I'll tell you, you'd be surprised. We had it right from 2000, 2001. And internally also there used to be pressure that we have the license, we have the brand name, why are we not launching? And the reason we did not launch was that I said that, managing your own money is a different kettle of fish. As you said some time back, that you can two stocks can wash out the sins of the rest, but that's not how you can or should manage public money. Because I take that fiduciary responsibility of someone's hard-earned money very seriously. So I said, till I have something which gives me some consistency, some foreseeability, I was very uncomfortable launching. So we waited a full 20 years, and which is when we had this artificial intelligence machine learning system, which could code all the expertise. And that's when we launched. And so therefore the results also, we know are predictable, because that system manages for this risk adjusted returns.
Right.
So you
Right.
make
Right.
sure you don't have big drawdowns, and then you reasonably participate in the upside. So even in 2023, for example, I think market was up 21. We were up close to 34%. So
just going to end with one maybe little unfair question, but it's I suppose in a lighter vein. When you look at your portfolio, I don't know how many you have, but let's imagine you have 30 stocks, just hypothetically, and you're feeling really great about these stocks. Obviously, everyone's always bullish on whatever they own, and then you find out that someone with let's call it a not so great track record at investing has bought heavily into some of the stocks you own. How do you feel, and do you start second guessing whether you've made a mistake, or do you not care about things like that?
I don't care. I mean, actually, I never even track what anyone is doing. Never have. I mean, I have never tracked it when I was on the sell side and writing research reports for FIIs. I never cared what anyone else's opinion was. And I have never, in fact, even tried to plug into the market gossip, so to say, to understand what anyone else is doing. It's of no relevance to me. I don't even keep track of it to even react and who's doing what. So I mean, my thing is it has to be very pure. I mean, it has to be what you think is right, and that's been a philosophy for life also. I mean, actually, I think it's something innate to me that I really don't. Think about what someone will think of what I am doing, or keep track of what, I mean, even in academics, I never looked over my shoulder. My benchmark was that am I doing my best? That I later on I should not feel that I did not do my best. So there were people, I mean, at IM, for instance, who had charts of everyone's grade points, whoever they were competing with. I never bothered. I was like, my thing was only that, am I doing my best? Am I bettering myself? So, and this, of course, I mean, this process is even one step removed, in the sense that, as I said, first of all, it comes out of a system. We call ours the PMS, the equity PMS, India Super 50. So I mean, we have a variety of systems. That one of the main bottom-up systems ranks every stock over 1,000 crore market cap, roughly about 750 stocks, from 1 to 750. So then we call it a human plus machine system. So out of maybe the top 75, we might choose 55. But we are not going to go to number 300 unless one of our other systems, for example, on commodities and all, recommends it. Otherwise, it is strictly by that. I really don't care who is or is not in that stock.
I think that sort of mindset that you have, where you only really care about what you are doing and what you think, do you think it's something you've developed consciously over time, or it's something hardwired into you?
I think it's mostly hardwired. As I told you, even in my educational career, it was pretty much the same. And I think maybe it comes out, well, my parents were both born in Peshawar. So my father used to call himself a Pathan. And I think this is part of that mindset, that you don't actually care what people think of you. So I think, I used to laugh about it, but I think some of it percolated to me.
I mean, absolutely. It's like they say, right? A lot of people, I mean, especially in investing, that the only thing that matters is when they looked in the mirror. Like it's like someone asked Buffett, right? Like who do you go to for advice? And he said, I just look in the mirror. And so I think that's a hallmark.
Buffett has not outperformed for 20 long years. And this includes that 2022 big drawdown, where, I mean, logically, given his stated philosophy, they should have got a lot of outperformance point. But even after that 2022, still the 20-year track record is underwater, or at least below the S&P.
Thank you so much for taking the time. It was so wonderful talking to you, and and like I said earlier, just learning so much about. See, it's easy. It's often easy to just talk about, what do you want to buy now, what do you want to sell now. But I think understanding the larger, broader core principles that someone uses in investing and business and just life more generally, and from someone who's actually implemented and seen the effect of those things, right? It's not just a professor sitting in a classroom who's never actually, himself or herself gone and or attempted to implement these things in the real world. So thank you so much for taking the time, and it was absolutely wonderful talking to you.
Thanks, Krish. And my advice would be that don't waste your time finding out what anyone else is doing. I mean, that's I've written a blog on whether crowds are wise or crowds are crazy, which actually talks about this particular thing, that you actually bring down the quality of your decision making when you ask people what they're doing.